Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the TGI. Thank God it's Friday, the 24th of May, Bull versus Bear webinar. Steve Miley here on the Call for Trading. Welcome, everyone. Welcome. Going to go for a usual regular run through in here today. We'll take a look at the calendar, what we've had, what we've got coming up. We'll take a look at some articles from the major news wires. What are the macroeconomic fundamental data, central bank, what are the geopolitical events, all of that's affecting the financial markets that you guys are looking at and trading right here, right now. We'll have a run through of what's going on in global markets, global stock indices, and we'll take a look a little bit at the where the interest rate markets are moving, what the short end's doing, what the long end's doing on the interest rate side, and then we'll have a look at some charts and look at the reports. So let's kick off with the data. So European data of note this morning. So UK retail sales data, you can see sea of red there, missing across the board. German GDP bang in line with expectations. Moving through into the US session now, it's fairly light really. Durable goods orders in here in 1 hour's time, just under 1 hour's time. Not really a big piece of data. Canadian retail sales not going to really impact onto us. And then maybe just watching out at 10 o'clock for the Michigan consumer sentiment data in here that we have coming out. So watching out for that. Waller is speaking as well. Waller's been on the wires quite a bit recently, so no sort of no big surprises probably coming from Waller. So yeah, durable goods in just under 1 hour. Michigan consumer sentiment at 10 o'clock. Let's jump to some of the articles from the major news wires. 5 things you need to start your day. So we had a significant sell-off yesterday. So initially, obviously, we had NVIDIA and the Fed on Wednesday. Market didn't really move too much after the Fed minutes, which were definitely more hawkish. And then we saw, obviously, the NVIDIA numbers come out. Stock futures leapt, all-time highs. The cash index gapped higher on the open to a new all-time high. So all looking very, very bullish. But then we saw a notable setback in here as we've seen ongoing concerns regarding the Fed come out, and then the bond market and the short and interest rate markets. So I think that's what you got to remember, that this was more of a move driven not because of what the actual Fed did, but the delayed reaction to what the Fed did from the bond market and the interest rate markets. After the Fed, the bond markets and interest rate markets didn't really do anything. It was yesterday, then we saw the bonds, the yields start to go higher. The short end interest rates, we can look at that via the easiest way for us to look at that is via the CME Fed Watch tool. They started to move higher, and so those concerns of maybe a more hawkish tone from the Fed looks like they came through into the bond markets. And there's obviously that was a delayed reaction. So the bond markets delayed reaction. So equities initially up, and then as the bond markets went to bonds sold off to lower prices, higher yields, then that had a negative impact onto the stock indices, which were potentially a little bit stretched because of NVIDIA, and then we got a reversal back lower yesterday. Now, subsequent to that, now bond markets have stabilized and a very little change this morning. And because of that, I think we've got getting a sigh of relief. My view is, despite the damage done yesterday, after the big gap high, NVIDIA still ended up like 9.5% up on the day, right? Then despite the damage done yesterday, I think we're going to, and we're already seeing it this morning, bargain hunters are coming out. So bargain hunters coming out. We've had a notable sell-off yesterday, and already we've seen a rebound this morning on the overnight on the futures, and the risk for me is back higher again, even though there was an undoubtedly damage done. Whilst the bonds stay stabilized, I think you have to have your eye on the bond market today. So we will look at those as we go through. So yeah, so that's where we're at really. So it was a delayed reaction. So there we have that. That's kind of covered in there. Fed Reserve Bostic. Now Bostic is more He's in the middle to more of a dove, if anything, Bostic, and more reasons I think that rates may stay higher for lesser. He said monetary policy has been less effective in slowing growth than in previous cycles. So that's a little bit of a concern as well, because that's Bostic is definitely more on the dovish side within the Fed. And if one of the doves is saying higher for longer, then maybe they will stay higher for longer. Okay, and then just pointing out that we've got Waller coming back in today. No central banks on the same path, exposing difference in interest rates that become the most popular investment strategy. Carry trades, so that's the carry trade. So we're seeing differentials of central bank approaches. UBS recommended selling the Swiss franc to buy US and Australian dollars. So the Australian, remember, the Swiss National Bank were the first to move, and potentially on the more dovish side. Okay, so hence selling the Swiss franc, and then on the other side, the US are maybe going to be higher for longer, but the Australian, the RBA, if you remember, were even discussing increasing interest rates. Okay, so we've got these both the carry trades and the FX opportunities because of differentials in interest rate policy. UK election coming up in early July the 4th, actually. Not having a slight negative dampening effect on the FTSE 100. Okay. What else do we have in here? So US futures edge higher, so we're getting a little bit of a rebound. Tech bulls way back in. So this is the bargain hunters I was talking about. US futures flat after the drop in here. Treasury yields are dipping, but benchmarks are, because remember, what you have to remember is benchmarks in here are actually lower because we effectively went sideways all week. So sideways all week, and then through till the Fed and Nvidia spiked up yesterday and then back down, and we're actually slightly lower on the week. I mean, we're not massively down on the week, but this is for European and global and US indices. Stocks fall. So this is like yesterday. This is from yesterday. Stocks fall despite Nvidia's inflation concerns. Why? So there wasn't any new data. It was just a delayed reaction for the bond market. Fed fears overwhelm AI theme. Gold recoils. But then futures recover. So this is then the overnight. So these two, the other reports were like from close of business yesterday, and now a futures recover after inflation jitters dent Wall Street. So yeah, inflation concerns. On the overnights in here, we have obviously with US down yesterday. Global indices lower. So the Nikkei and the Hang Seng down between 1 and 1.5% this morning. European exchanges between 2 and 4/10 lower this morning, and having been hit yesterday, so the Nasdaq was about 4/10 lower. It's only 4/10 down on the day yesterday on the cash market. Remember, it leapt up though and then came, so it's a bigger journey than that because it leapt up pre-market on the open, and we're actually rebounding in here this morning, so we're back up 3/10. So net the Nasdaq, from Wednesday was down 4/10 and now is back up 3/10. So it's been more of a journey than that, obviously, but the market kind of already starting to reject, nearly 3/10 up on the S&P as well. So here's the move in the Fed Watch tool. So this is what kind of really sparked this. We did the analysis yesterday, right? The market post Fed was very little change, but if we look here now for September, we're almost 50-50 rate cut or not, right? So actually there's an outside chance of a rate hike, but I mean there's basically 50-50 in here whether we get a cut or not by September. And if we go then to November, I actually never looked at November. November now is pricing in basically kind of roughly say 2/3, 1/3, 36, 37% unchanged and 63%. So we're going to likely have cut by November, but if we go by year end, we're kind of still now sitting at, this is one cut here and this is unchanged. So we're actually at 57% for one cut or unchanged. So less than a 50-50 chance. So we're less than a 50% chance. So only a 43% chance. Basically, we get 2 cuts by the end of the year. And then we start obviously moving into next year. So the rate cuts have definitely certainly been pushed out. And this is a definite shift here into December. both on the September, November, December, definitely a shift September and December in here compared to just this time when we were on yesterday. Okay, and it was this move along with, so that's on the short end, remember the short end, and then here's the, remember this was parallel. So that this was after the Fed on Wednesday, this bar here when very little had changed, and then yesterday, boom, to higher yields. Remember, this is yields. US 10-year going to higher yields, that's lower prices. And you can see in my reports from overnight in here, just sticking to a bullish tone here on the long end, the very long end, the 30-year. But we goes to the 10s, the 2s, and the 5s. The sell-off yesterday was enough for me to shift bearish on the bonds. So 10s, 5s, and 2s, all more negative in here, and now looking at a negative bias, so the risk to the downside on bonds, and that's what dampened the stock indices yesterday. And then haven't shifted bearish here, but and was, you know, it was a very obviously negative session, having gapped up new all-time highs. Well, it didn't gap up on the futures, but the cash markets gapped higher yesterday to new all-time highs, and then obviously significant sell-offs. We're hanging on to, whilst hanging on to the first level support levels in here. So the first level supports you see here and here on the Nasdaq and the S&P. Whilst above these, I'm staying bullish. Okay, but if they start to get, if those initial support levels start to be given up, then we start to turn more negative. And here's the bond. So there's the sell-off in the, so this is the 10-year note. Here's the 2-year note in here. So it was these sell-offs yesterday that created the sell-off in the bond markets, that triggered that sell-off. But you can see now, overnight in here, we're flat, you know, so holding on. Now, if these start to break, you know, particularly I'd keep an eye on the 10. This is actually on the June contract. You might need to look at the September contract. But if we break below the low from here, from earlier in May, okay, so this is on the June, but I think you need to go and look at the levels in here on these. But we're still actually on my reports in here. We're still on the June contracts as well. So you're gonna have to take the levels. Go take the levels from the June in here, okay. But if we start to break down through the initial support levels in here, so 108.15 there on the 10-year. Particularly if we start to break below there, that's that level there, that 108.15. So if we start to break down below this low here, for example, on the 5-year, the 2-year starts to give up support, 5-year starts to give up further support. So basically start to break down below yesterday's lows, then you've got to think that stocks are going to react quite negatively to that, and we could go south again. So watching out for, particularly, I think that's the big level I would mark. It's on the June contract, ZNM4. If you get below 108.15, then it all looks very vulnerable. Okay, so just watching out for that. For even if you're trading stocks. On the stock side, though, you know, despite this very negative day, so obviously we pushed higher, new all-time high. Cash markets gapped higher. We're pretty much back up here on the highs. We did initially push higher, and then an abject failure, bearish outside pattern. Bearish engulfing candlestick, engulfing the previous 3 sessions. That's a really negative candlestick to engulf. 1, 2. Did he actually engulf the low there? 18,633. 18,6. Yeah, it did. So it engulfed the 3 previous sessions. So Thursday's pattern was outside the whole of this week. Monday, Tuesday's, Wednesday's price action. So that's a very negative session. However, the market has rebounded this morning. I think whilst above the yesterday's low, I'm watching out again for that 10-year level. If we take out yesterday's lows, then this could be another significant down day. But I think there's going to be risk that we get bargain hunters come in and going into the end of the week. Remember, it's a long weekend. Do need to warn you about that. Please do read the email we sent out. We'll try to put a post into the forums as well. It's a partial day. Don't get caught having an open position at the end of well, it's not at the end of the day, because it's depending on the market you're trading, but I think it's for the equity markets, it's midday Eastern, midday Chicago, excuse me, midday Central, I think it is. But you need to check, guys, right? Because it's different for different markets. If you're trading bonds, if you're trading currencies, if you're trading oil, go and check for your market. But they're closing early, okay? Don't get caught in an open position because you'll lose your account, okay? So a word of warning. My strong recommendation is just don't trade. It's a holiday. Have the holiday off. You know, it could be gappy. It's a UK holiday as well. So markets are going to be, you know, there's going to be less liquidity. So just don't trade, is my opinion. And what I think what's really interesting is, if you can see on both these, the NQ actually holding above this 13-period EMA. This is always a good trend indicator. on the daily 13 period EMA. Look at the S&P yesterday, boom, right down to it, just touched it, and then today bouncing off of it. So for me, there's still an upside in here today, but watching out. If we take out yesterday's lows, markets look very vulnerable again, and watching out also on the bond market there, particularly that 10-year note. If it takes out that support level, then it looks vulnerable. Bonds look vulnerable to the downside, and that should or likely pull equities down with it. All right, guys, I'm going to wish you all a great trading day. Take care, stay safe. Have a great weekend too. Have a great long weekend. Please, don't just try not to trade. I would suggest on Monday. Have a great long weekend if you're in the US, also if you're in the UK. And there's no webinar on Monday. Okay, we'll be back with you on Tuesday for the next webinar. All right, guys, take care, stay safe. Bye.